Michael Burry has just forecast that we're going to see the mother of all crashes. Now, people listen to what he says because he correctly called the bubble in 2001 and 2007, so maybe he's right again this time. So in this video, we'll look at what he said, but also hopefully we'll learn along the way about the dangers of leverage and margin. So if you do want to learn more about investing, one way to do that is by signing up for our free weekly market roundup. There'll be a link beside me and in the description below me. So let's look at what Michael J. Burry is saying in a bit more detail. So here's the tweet on June the 17th where Michael Burry says that there's lots of hype and speculation, and that's drawing in lots of retail investors. That's normal investors like you and I, just before the mother of all crashes. And he describes the rally in some of these stocks as a FOMO parabola. So that's a fear of missing out trade where people see markets moving up and they're drawn into the market just before a crash. And of course, the parabola is one of these exponential increases in share prices that we've seen for some of these meme stocks recently. And his point is that these exponential rises, these FOMO parabolas, don't resolve sideways, which is his way of saying there's going to be a big crash. That's how it's going to end. Now, the 2 points which I take issue with are to do with contagion from the crypto market into the broader market, but also the meme stock market into the broader market. Because his point in the second half of the tweet is that when crypto falls sharply or meme stocks fall sharply, that'll spread to the broad market. And that way Main Street is going to lose huge amounts of money. And the analogy he's using here is between what happened in 2007 when a tiny market, which was the subprime housing market, spread volatility throughout global financial markets. In fact, there was almost no market that was unscathed by that sell-off. And his point is that history hasn't changed. We're going to see a widespread sell-off triggered by sell-offs in these smaller markets. And then shortly after that, he tweeted about crypto. And he said the problem with crypto, as in most things, is the leverage. And this I'd kind of agree with. And it's not just cryptocurrency which has its own leverage problems. As we'll see, equity markets may suffer from this as well. Shortly after Michael Burry made those tweets, he deleted his Twitter account. So sadly, we're not going to see any kind of follow-up on his previous comments, unless he creates a new account. So let's start off with a cryptocurrency story, and we certainly have seen a big sell-off in cryptocurrency this year in 2021, as there's been a succession of negative news stories, such as this story in the FT about China cracking down on cryptocurrency mining. Cryptocurrency peaked in the first quarter of 2021, and in this graph I've scaled the values such that they're equal to 100 on May the 9th. That was roughly when the peak occurred. And here I've tracked the value of Bitcoin, which is in red, and the value of Ethereum, which is in green. And as you can see beneath me, the current value of Bitcoin as I make this video is about 40% down for this year. And Ethereum over the same period of time has roughly halved. And these two dashed red lines you can see are the date of Michael Burry's tweet. That's the first red line. And the second line is China clamping down on cryptocurrency mining. So it certainly is true that the cryptocurrency market has sold off this year. How about meme stocks? Well, here's a basket of those meme stocks, again scaled such that their value was 100 at the beginning of 2020. And while it's certainly been a rough ride for many of those meme stocks, you can see the one which is faring worst, which is just above me, which is BlackBerry, is still up 88% since the beginning of 2020. So these meme stocks certainly haven't sold off, at least not yet. But the key question is whether the sell-off in these small markets, crypto and meme stocks, will affect a much broader market, which is the S&P 500, because that really could make the rest of us poor. So let's take a look at how the S&P is holding up. Cryptocurrency peaked in May, which is roughly above me on this graph, but you can see that it's made hardly any difference, the 50% sell-off in crypto, on what's happening to the S&P 500. And the cryptocurrency market is much bigger in terms of market capitalization than those tiny meme stocks. So I think it's very unlikely that the tail could wag the dog and those tiny markets could actually drag down the S&P 500. If the S&P 500 does crash, I suspect it'll be other reasons which trigger the sell-off. But frankly, I think it's unhelpful trying to time these market crashes. Michael J. Burry may say he knows when it's going to happen and what the trigger will be, but he doesn't. Just because he timed those market sell-offs in the past doesn't mean he has some special insight. But where I think Michael J. Burry has some really interesting things to say is about leverage, because that, after all, was what triggered many of the big sell-offs in the past. So let's see what the fundamental problem is with leverage and where we stand with leverage at the moment. And to understand leverage and its role in market movements, it's good to understand margin. Now that's the amount of money which a customer deposits with a broker when they want to borrow money to invest money. And the reason why they do that is to amplify their returns. But the problem is that it amplifies not just the positive returns, but also the negative returns. To see an analogy with the current market rally, let's look back to markets between 2004 and 2007. This is what they looked like. And over that almost 4-year period, equity markets were very strong. It was a huge rally of about 9.5% per year. And this dashed red line you can see extrapolates that line into the future, which is typically what we tend to do as investors. It's called recency bias, when if we've had a recent rally, we think that will continue into the future. Now, the longer a rally lasts, the more people get convinced that it'll continue. And that means that people tend to take more risk towards the end of these rallies. So if market returns have been just under 10% for the last 4 years, why not amplify your returns through leverage? For many investors, it's very easy to do, to borrow money from your broker and invest that borrowed money, and that amplifies your returns. So let's say we have $10,000 to invest, but we actually want to invest $100,000. How could we do that? Well, maybe we could borrow $90,000 from our broker. Our total investment would be worth $100,000. But after a strong market rally, it's often the case that markets correct very sharply. And of course, that's exactly what happened in 2008. You can see there was a very sharp fall in equity markets triggered by that subprime market meltdown. And if we look at the effect on a $100,000 investment, it would have fallen very sharply to just over $44,000. Now, we borrowed $90,000, but of course we'd still have to pay that back. And once we do repay our $90,000, we'd end up underwater by $46,000. In other words, we'd have lost over 4 times our initial investment. And certainly for some people, this would create financial ruin. And this is the dark side of leverage, which is that it multiplies up our losses as well as our gains. So in this case, we'd have taken a 56% loss and turned it into a 560% loss. So is it really the case that people get more margin towards the end of a rally than they do at the beginning? One of the US regulatory bodies, called FINRA, actually collates information from all of the brokers in the United States on how much leverage their customers have. And this is the aggregated number for the entire US, stretching back to before 2000. Notice how recently, during this post-pandemic rally, the amount of leverage has increased hugely. It's now standing at $862 billion. And also notice that the peaks in margin tend to happen just before a market peak. So here's one in 2000, which is underneath me, which was the height of the dot-com bubble. And here's another acceleration in the amount of margin debt just before the global financial crisis. So in the next graph, we'll look at the year-on-year change in that margin debt to see how it varies in relation to market movements. So this upper panel, which you can see here, is the year-on-year change in the amount of margin debt. A positive number means there's more margin debt, so the amount of margin debt is increasing as people take out more leverage, and a negative number means that the amount of margin debt is shrinking year on year. And here in the lower panel, you can see the peak to trough fall in the S&P 500. That's relative to the previous all-time high. And sometimes people call this a drawdown graph. And now you can see really clearly that acceleration in the growth of leverage came just before the dot-com bubble burst. And in the aftermath of that dot-com bubble bursting, you can see that equity markets took a huge tumble. with a peak to trough loss of around 45% and a huge amount of deleveraging taking place while equity markets fell. And then the same thing happened again during the global financial crisis, an acceleration in the amount of leverage and a very significant fall in equity markets, this time by around 50%. And this is where I agree with Michael Burry, which is that leverage is often a problem when it comes to market sell-offs. And particularly worrying is this acceleration we've seen in leverage through this pandemania bubble. If it's anything like the previous two crises, then we could be about to see a significant sell-off. But wait, before you run off and sell all of your shares, that's certainly not a foregone conclusion. Just because we've had two previous episodes where equity markets sold off after this acceleration in leverage does not mean that's going to happen again. And remember, we've really just got two data points here. And if you notice, there are also smaller accelerations in leverage around 2010 and around 2013. But we didn't have a market crash in those cases. In fact, equity markets did just fine. So don't be convinced by just one number that equity markets are going to crash. There is no perfect predictor for equity markets. Nobody knows over the short term what's going to happen. Not Michael J. Burry, not me, and let's be honest, not you either. Now, one of the jobs of FINRA, the regulator who provided that brokerage leverage data, is to protect investors from hurting themselves with leverage. And because of that, it protects investors in two ways. The first one is called initial margin. So FINRA imposes a constraint which means that brokers can only lend customers up to half of the price of any margin security, like shares. So that's the cap on the initial leverage you have when you open a position in a trade. The second way it protects customers is with maintenance margin. You may have heard of margin calls because if the value of your equity falls, your broker will ask you to post more margin. That way you make small payments to the broker as markets gradually fall so that you don't have one massive shock when there's a very sharp fall. And generally those margin calls happen when the equity, which is how much of the stock you've funded, falls below a quarter of its market value. So that's a cap on ongoing leverage as the price of the security varies over time. Now, in the case of cryptocurrency, something very unpleasant can happen called a liquidity cascade. Now, if you're buying shares on margin, you have to post cash as collateral. And the nice thing about cash is it doesn't crash, unlike equity. With cryptocurrency, however, you can post other cryptocurrencies as collateral. And this example beneath me is taken from the Kraken website, and that's a cryptocurrency broker. And they explain how you can fund a $1,500 worth position of Bitcoin by posting Ethereum as collateral. So in this case, you'd have got 3-to-1 leverage when you open the position. If you look at the year-on-year change in the price of Bitcoin and Ethereum, you can immediately see the problem, which is that the price of those two cryptocurrencies is highly correlated with one another. So in the recent cryptocurrency market sell-off, you can see that Ethereum was falling at the same time as Bitcoin, which means that the value of your collateral would be falling at the same time as your position was falling. That means it's much more likely that your position will be underfunded and you'll get a margin call. So this creates a kind of spiral of unwinding positions. The value of cryptocurrency falls, the value of your collateral falls, so many people become forced sellers at the same time that markets are falling. And this is what we'd call a liquidity cascade. This wouldn't be a problem, notice, if we'd use some kind of stable coin which is linked to the value of the dollar, because that has a much more stable price. And it wouldn't be positively correlated with riskier cryptocurrencies like Ethereum and Bitcoin. Now in May in 2021, there was a Bitcoin flash crash, as it was called. This is when markets fall very sharply over the space of a few hours. And the reason given for it was that Bitcoin was used to collateralize Bitcoin trades. And that means when Bitcoin fell heavily, leverage bets were quick to fold. So it seems as if the protections which FINRA has for equity just don't apply to the cryptocurrency market. And I suspect what's going to happen over time is that those regulations will be tightened up. My final point is a warning about prophecy. Here's a beautiful painting of the prophet Isaiah, who's very carefully listening to what God's saying and writing it down in the Bible. And the weird fact is, even though we have huge experience of prophets being unreliable, we're still desperate for people to tell us what the future holds. I get asked to do this all the time. What's your forecast for the housing market, for the equity market, for single stocks? But I try to avoid this at all costs. And that's because it's not helpful. You can't really forecast markets over the short term. What you can forecast fairly accurately is what equity markets do over decades, because there, the gradual increase in earnings drives equity markets higher. And over long periods of time, equity markets become much more predictable. So if somebody does give you one of these short-term forecasts, don't believe them. Nobody can make reliable forecasts over a period of around 5 years or less. And I'll finish with this incredible quote from Morgan Housel, which is that everything is sales. So when somebody makes a forecast, think, why are they doing that? So let's say Michael J. Burry says markets are going to fall. Is that because he's got a short position on the S&P? If that's the case, then he's probably trying to trigger a market sell-off, which will work in his favor. In investment, this is called talking your book, and it might be the case that Michael Burry, in saying that there's going to be the mother of all crashes, is hoping that's going to be the case once he's made that prediction. In other words, that it'll be self-fulfilling. So I'd be wary of these prophecies because it might just be somebody trying to move markets in their favor. And of course, if markets do crash, that's great because it means that equities are on sale. Just remember that that's not a time to sell, it's a time to buy. And it's actually a feature of equity markets that occasionally we do have these sales. But what I can guarantee is that nobody knows when those crashes will happen. Now, if you do enjoy these videos, why not support us? It's as easy as just clicking thumbs up on the video or subscribing to our channel so you don't miss future content. And as always, thank you for listening.